Imagine two neighbors living in identical houses right next to each other. Let us call them Henry and Ivy. Henry works 80 hours a week as a high-powered consultant, and at the end of the year, his W-2 shows exactly $100,000 in income. Ivy, on the other hand, does not punch a clock. She has a portfolio of long-term investments that also paid her exactly $100,000 in gains this year. They have the same gross income. They buy the same groceries. But when April 15th rolls around, Henry is going to write a check to the IRS that is thousands of dollars higher than Ivy's. In fact, depending on how Ivy structured her sales, her tax bill might actually be zero. Same income, totally different life. This is not a mistake in the system. It is the geometry of the cash flow quadrant, and understanding it is the difference between working for money and having money work for you. Most people have seen the diagram. It is Robert Kiyosaki's famous square with 4 letters. E for employee and S for self-employed on the left, B for business owner, and I for investor on the right. We usually talk about this in terms of mindset or freedom. We say things like, employees want security, while investors want freedom. That is true, but it is also a bit abstract. The real, tangible difference between the left side and the right side of that quadrant is not just psychological. It is written directly into the United States tax code. The government treats money earned from sweat very differently than money earned from capital. Today, I want to walk you through exactly why that is, how the math works, and why moving from the left side to the right side is the only way to stop overpaying for your own existence. Before we open up the tax brackets, I want to make a quick deal with you. Most financial videos give you hype. I try to give you the actual mechanics. If you learn just one strategy today that saves you 1% on your lifetime tax bill, that is worth thousands of dollars. That is a pretty good return on investment for clicking a button. So if you appreciate a quieter, more logical approach to money, go ahead and subscribe to the channel. I appreciate it, and it helps me keep the lights on without selling you a course. Let us start on the left side of the quadrant with the employee. This is where most of us start, and frankly, where most of us stay. The common belief here is that the path to wealth is simply a higher salary. We tell ourselves that if we could just get that promotion to $150,000 or $200,000 a year, we would be rich. We chase the gross number. We brag about the gross number at dinner parties. But the gross number is a lie. When you are an employee, you are trading your time for money, and that transaction triggers the most aggressive tax schedule in the IRS arsenal. It is called ordinary income tax. The tragedy is that the harder you work and the more value you provide, the higher the percentage the government takes from your last dollar. You are running up a hill where the gravity gets stronger the higher you climb. Let us look at the actual numbers for 2025. Ordinary income is taxed in 7 brackets, starting at 10% and climbing all the way to 37%. If you are single and making decent money, you move through the 10% and 12% brackets pretty quickly. By the time you earn over $48,000, every new dollar is taxed at 22%. Break 6 figures, and you are hitting 24%. If you are a high achiever earning over $200,000, the government is taking 32 to 35 cents of every extra dollar you earn. And we have not even talked about state taxes yet. This is the progressive tax system. It is designed to take a larger bite out of people who earn more wages. When you are an employee, your silent partner, Uncle Sam, gets a raise every time you do. You do all the late nights, you handle the stress, you deal with the politics, and he simply waits at the finish line with his hand out. Here is the psychological twist that keeps employees trapped. You rarely feel the pain of this tax because you never actually touch the money. It is the genius of the withholding system. Your employer strips the taxes out before the direct deposit hits your bank account. You learn to live on the net amount. You budget based on what hits the checking account, and you treat a tax refund in April like a gift, even though it is just your own money being returned to you without interest. This anesthetic makes us passive. If employees had to write a physical check to the IRS every 2 weeks for 30% of their paycheck, there would be a revolution by Tuesday. But because it is invisible, we accept it. We stay in the E quadrant, working harder for raises that are taxed at higher marginal rates, running on a treadmill that is programmed to speed up. The solution here isn't necessarily to quit your job tomorrow. That is reckless. The solution is to acknowledge the ceiling. You have to realize that as an employee, you have zero control over your tax efficiency. You have very few write-offs. You cannot depreciate your skills. You cannot deduct your commute. You are a sitting duck for the tax code. The first step to leaving the rat race is understanding that you cannot win the game of wealth solely through W-2 income. You can make a great living, sure, but you will always be swimming upstream against the current of ordinary income tax rates. To build real momentum, you have to find a way to move your income into a different category. You need to turn your labor into capital. But wait, if you think income tax brackets are the bad news, I have something worse. There is a second tax on your paycheck that investors do not pay at all. It is a flat tax. It starts from $1, and it is arguably the most expensive insurance policy you will ever buy. I am talking about FICA, the payroll tax. This is the silent killer of wealth building in the early stages. Most people look at their pay stub and see Social Security and Medicare and think, well, that is just for my future. And technically, you pay about 7.65%. But that is only half the story. Your employer pays another 7.65% on your behalf. Now, you might think, great, the boss is paying. But in reality, that is money the company has budgeted for your position. If they did not have to pay that tax to the government, that money could theoretically be in your pocket. So the total cost of your employment includes over 15% in payroll taxes right off the top, before you even worry about federal or state income tax. This is a massive drag on your ability to compound wealth. It is a flat tax that hits you from the very first hour you work. Now, let us switch lenses. How much Social Security tax does a passive investor pay on their dividends? 0. How much Medicare tax do they pay on their long-term capital gains? Generally, 0. There is a surcharge for very high earners called the net investment income tax, but for the vast majority of investors, FICA is simply not a thing. This is a staggering advantage. Imagine if you could give yourself a 7 to 15% raise just by changing the definition of your income. That is effectively what happens when you move from the left side of the quadrant to the right. The tax code was written to incentivize investment, not labor. Whether you agree with that morally is a separate debate, but mathematically it is undeniable. Capital is protected, labor is taxed. The twist here is that payroll taxes are regressive. They hurt lower and middle earners the most. There is a cap on Social Security tax. In 2024, it was around $168,000. Once you earn more than that, the Social Security tax stops. So the ultra-wealthy CEO actually pays a lower percentage of their total income to Social Security than the person working in the mailroom. But the investor? The investor bypasses the system entirely. They are playing a different sport. While the employee is worrying about maximizing their 401k to lower their taxable income, the investor is generating income that does not even trigger the payroll tax system in the first place. The protocol here is simple to understand, but hard to execute. You need to acquire assets that pay you. This is the core of the Cashflow Quadrant. Every dollar you receive from dividends, rental income, or capital gains is a dollar that has escaped the FICA trap. Even if you are still working a job, your goal should be to build a side stack of capital that generates this tax-privileged income. Eventually, you want the right side of the quadrant to eclipse the left side. When your passive income exceeds your expenses, you are not just financially free, you are tax optimized. You have effectively resigned from the payroll tax system. Now, you might be thinking, okay, Tom, I get it. Payroll taxes suck. But investors still pay capital gains tax, right? Well, usually, yes. But what if I told you there is a magical zone where you can make nearly $100,000 of profit and pay absolutely zero federal income tax? It sounds like an offshore loophole, but it is right there on page 1 of the instructions. There is a myth that the rich always pay high taxes, or at least they should. But the tax code has 3 separate buckets for long-term capital gains: 0%, 15%, and 20%. Notice that first number, 0. This is not a deduction. This is a tax rate of nothing. If you are an employee, there is no 0% bracket for your wages beyond the standard deduction. Every dollar of salary is taxed. But for the investor, the government explicitly says that if your income is below a certain threshold, your investment gains are tax-free. They want to encourage you to hold assets for the long term, so they dangle this carrot. Let us look at the 2025 numbers. If you are married, filing jointly, the 0% bracket for long-term capital gains goes all the way up to roughly $96,000 of taxable income. That means a couple could theoretically earn $96,000 purely from selling stock they held for over a year, and their federal capital gains tax bill would be 0. If you are single, the limit is around $48,000. Think about that comparison. A single employee making $48,000 pays 12% federal tax plus over 7% FICA. A single investor making $48,000 in long-term gains pays 0 federal tax and 0 FICA. They keep almost every penny. This is the most glaring disparity in the quadrant, and it is perfectly legal. The psychological barrier here is that people are afraid to sell assets because they hate paying taxes. It is called lock-in effect. But ironically, by not selling when they are in lower income years, like maybe a sabbatical, early retirement, or a year between jobs, they miss the chance to harvest these gains for free. I see people with modest incomes holding onto stocks for decades, terrified of a tax bill that, if they did the math, wouldn't actually exist. They are operating with an employee mindset where every dollar is taxed, rather than an investor mindset where you can choose your tax rate based on your timing. The wealthy do not just earn money, they engineer the timing of their income to hit these specific brackets. The strategy here is called tax gain harvesting. It is the opposite of the loss harvesting you usually hear about. If you find yourself having a low income year, look at your portfolio. You can sell your winners, realize the gain at the 0% rate, and then immediately buy them back. You have just reset your cost basis higher without paying a dime in tax. You have effectively washed the tax liability out of that asset forever. This requires planning. You have to know where your income falls relative to those thresholds. But this is exactly what the I quadrant is about: being proactive with your capital rather than reactive with your paycheck. Now, before you go and sell everything, there is a trapdoor you need to know about. It is called stacking. You cannot just view your capital gains in a vacuum. The IRS stacks your income in a very specific order. And if you get this wrong, you could accidentally push yourself out of the 0% zone and into a tax bill you were not expecting. A lot of people think their job income and their investment income are 2 separate buckets that don't touch each other. They think, my salary is taxed here and my stocks are taxed there. That is dangerous thinking. In the eyes of the IRS, it is all one big tower of income. The crucial detail is the order in which they build the tower. They lay down your ordinary income, your wages, bonuses, interest, as the foundation. Then, they stack your long-term capital gains on top of that. This stacking order matters because your wages can use up the space in the lower brackets, pushing your capital gains into the higher zones. Let's run a scenario. Say the 0% capital gains bracket ends at $48,000. If you have zero job income, you can have $48,000 of gains tax-free. But what if you have a job paying $40,000? That wage income fills up the first $40,000 of the tower. Now you only have $8,000 of room left in the 0% bracket for your capital gains. If you sell $20,000 of stock, the first $8,000 is tax-free, but the remaining $12,000 spills over into the 15% bracket. Your job income essentially crowded out your tax-free investment income. This interaction is why high-income employees have such a hard time shielding their investment gains. Their W-2 salary has already used up all the cheap tax brackets. This leads to a weird psychological trap. As you earn more salary, you are implicitly increasing the tax rate on your investments, even if your investment strategy hasn't changed. It feels unfair, because it is. The system is designed so that the W-2 worker acts as the base. The E quadrant is the foundation that supports the tax revenue. The I quadrant is the penthouse that gets the view. If you try to live in both worlds, working a high-paid job while investing, you get the worst of the stacking effect. You pay high rates on your labour, and your labour pushes your investment gains into the 15 or 20% brackets. You never get the 0% deal. This is why the ultimate goal of the wealthy is often to reduce ordinary income entirely. So how do you fight the stack? You use asset location. If you are a high earner, you know your ordinary income is going to clog up the lower brackets. So, you should prioritise keeping tax-inefficient investments, like bonds or high-dividend stocks, inside tax-sheltered accounts like 401ks or IRAs. Keep your growth stocks, the ones that generate long-term capital gains, in your taxable brokerage account. Why? Because even if your salary pushes you into the 15 or 20% capital gains bracket, that is still far better than the 37% ordinary rate. You want to expose your growth to the capital gains rates and shield your yield from ordinary rates. It is about matching the right asset to the right tax treatment. When you step back and look at the Cashflow Quadrant, do not just see it as a career guide. See it as a tax map. On the left, the terrain is hostile. You have steep inclines of progressive taxation, slippery slopes of payroll taxes, and no shelter from the elements. You are hiking in a storm. On the right, the terrain flattens out. The rates are lower, the brackets are wider, and there are shelters everywhere. The wealthy understand that it is not just about how much money you make, it is about which path that money travels to get to you. $1 million earned as a salary is a fraction of $1 million earned as a capital gain. That is not just a saying, it is the mathematical reality of the system we live in. I want you to try an experiment. Look at your last tax return. Find your effective tax rate, that is, the total tax divided by total income. Then ask yourself, what would that number look like if all my income had been capital gains? The gap between those two numbers is the cost of staying in the E quadrant. It is the price of the ticket. If you found this breakdown helpful, do me a favor. Share this with a friend who thinks a raise is the only way to get ahead. Let's get them looking at the right side of the map. I'm Tom, this is Tom Talks Money, and I will see you in the next one.